Kristen Bitterly from Citi Global Wealth Management joins us. Kristen, technology, buying opportunities. Would you go into this sector after some of the carnage that we've seen at this point?
So what's really interesting is when you look under the surface, while the NASDAQ is down around 25%, when you break it down, we have 60% of those underlying stocks are down 20% or more, 40% are down 40% or more, and 30% of those underlying shares are down 60% or more. So it's a very natural question as to whether or not there are opportunities here. There's two things to keep in mind, though. In this market, and given some of the conditions and some of the headwinds, we really want to delineate between what are quality, profitable companies and what are essentially really hyper growth stocks that are call options on unknown futures. We are leaning into quality, and we are happy building positions in some of those names for the long term. The second piece is look to some of the subsectors out there, like cybersecurity, where this is an area where there's going to be durable demand. It is no longer a nice to have. It's a need to have from a corporate governance standpoint, and really has become the governance part of ESG, environmental, social, and governance. So some of the sectors we really like, but really focus on quality. How do you define quality right now in technology? Can you break that down any more specifically? Of course. So these are strong companies that are basically, they have been consistently growing their earnings. They lean towards that durable demand, and they've actually also been consistently growing their dividends. And this goes beyond technology in terms of areas where we have been adding exposure very comfortably over the past 6 months. So this expands beyond technology, but actually into areas, for example, like healthcare, where there is durable demand, where you see areas like pharmaceuticals. Those are the areas. And if you look at the broad-based sell-off that we've seen in equity markets here to date, those types of companies are actually dividend growers. U.S. equity dividend growers are down only around 7%, where the broad-based market is down 15%. So this is not a unique view to technology, but really taking a step back and looking at those quality companies more broadly.
Mike, the B of A fund manager survey today, which gives a good sense of where the crowded trades are, where the consensus, showed that technology stocks are the biggest short since 2006.
Yeah, so essentially active fund managers are as underweighted in that sector as they have been since 2006. You know, a lot of it is just about, tell me what the market did in the last few months, and that's going to be coloring their stated positioning. But again, that to me why it says that there's a little bit of cleaner setup here in terms of no longer as crowded in that area. I just think that the general market feels as if it got pretty defensive in a hurry. Doesn't mean it's all culminated, doesn't mean that the downturn is over, but it makes sense that we paused on the downside momentum where we did, just ahead of that 20% pullback level in the S&P 500.
And Kristen, you mentioned healthcare, I think just now, as one of the places you like for quality. Can you get more into that? Is it biotech, which has lagged? Is it pharmaceutical companies, some of the insurers? Because the whole group actually has been working.
The whole group has been working, and we've seen that as an area of really strong outperformance compared to the broad-based market. But pharmaceuticals is the area that we like looking forward in terms of, again, it goes back to this concept of what is going to be durable demand. And I think what's really interesting is if we look at what's fueled some of this rally today around retail sales and consumer spending, there are some cracks in terms of this consumer story. So when you look at what is actually fueling that spending, we are seeing pre-pandemic levels of the personal household savings rate. We're seeing pre-pandemic levels when it comes to credit card balances. And we had a record 537 million credit cards opened in the first quarter of this year in the United States. And so when we see those cracks starting to unfold as to how consumers are actually spending, you want to lean into those areas like pharmaceuticals that will have durable demand.
Quickly, how much of your portfolio should be in cash right now?
None. With the inflationary pressure.
Stocks and bonds?
Bonds. So what we really like in terms of where we have high conviction is bonds are back. Actually adding fixed income exposure in terms of whether we've hit peak rates at this rate or whether we're going to see it throughout the course of this year. We are very confident in adding high quality fixed income in terms of U.S. Treasuries, investment grades, and also in municipal bonds, where we're seeing that yield ratio compared to tax equivalent at 90%. That's an area to add some hedging, diversification, and really asset allocation is back.